You're about to hear my conversation with Arup Datta, Senior Vice President, Portfolio Manager, and Head of Global Quantitative Equity at Mackenzie Investments. Today, we'll talk about some recent product launches in the Canadian market that bring the team's quant abilities to everyday investors, why Canadian and international equity markets are ripe for capturing alpha, and why investors might find the next 15 years very different from the last 15 years. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction and Mackenzie Private Wealth. Today, I'm joined by Arup Datta, Senior Vice President, Portfolio Manager, and Head of Global Quantitative Equity at Mackenzie Investments. Arup, thank you for joining the podcast today.
Thank you, Rajan. Very happy to be here.
Arup, I am speaking with you just on the heels of Canada Day, and I know you're in the midst of 4th of July celebrations, so I want to ask you a question. The majority of this podcast is actually going to be spent on the international equity space, but your team has most recently launched a series of new solutions, including a Canada-focused strategy. I know this question is a bit of a surprise for you, but I thought maybe we could spend the first few minutes of our conversation with you talking to us about these recent launches and why you're excited about them.
Thank you, Rajan. Happy Canada Day, a day late, and happy 4th of July, which is just a couple of days from now. Nice times for both the countries. And thank you to Mackenzie Retail for having found us in terms of today. Many of our institutional offerings now available in retail space. Towards that, in April, we launched a few new funds. One was the US Alpha Extension Fund, where for the first time, Canadian retail can have access to our shorting capability. It's a beta 1 strategy, but it's a US 1 2020 strategy where we are a beta 1 trying to beat the S&P 500, but we also do some shorting there to give you some extra alpha. So that's one area. The other one, I was also very happy to launch Canada-focused strategies, where I've always known in my long career of now in my 33rd year that Canada is a rich area for quantitative or very disciplined stock picking. And so I was very happy when retail came to me and said, can you launch a Canada-focused strategy, which, as you know, is a mix of Canadian and US equity investments. I've done US equity investments all my career, Canada most of my career. So I was very happy to launch a couple of Canada-focused strategies a few months back. So I'm very happy to highlight that, just extending our capabilities or what we can bring to the table, hopefully into different areas. And hopefully there's something retail likes in what we talk, where one of your advisors may be interested in.
Thank you very much, Arup. Now, I just want to ask you a follow-up question based upon what you just shared. When you were talking about Canada, you indicated that from your perspective, Canada was ripe for this type of strategy. Why is that the case?
I would say Canada, again, is a little bit of a less efficient market than the US. To me, as I like to say, Rajan, if you can deliver alpha in US large cap, which I have done all through my career, you can deliver alpha everywhere else. So to me, Canada focused is a good combination of Canadian stock picking from using a very disciplined fundamental quant approach, along with US stock picking, which I've also done all my career. And that's why it's an interesting area. Also, Canada Focus has a nice blend. US with its tech leadership, all that heavyweight. Canada with its materials, with its energy, financials. So the combination of these two in terms of sector exposures makes it a very all-rounded exposure. And our stock selection models do work in all these sectors. So that's why I think Canada Focus is a very interesting strategy. And I'm very happy to have gone live with it a few months back.
That's great detail, Arup. I love how when you were describing the quantitative approach, you were making reference to how it's disciplined. It's a fundamental approach. And what I've learned over the years of working with you is it's an approach that's portable. And you just alluded to that already. U.S. large cap, portable now over to Canada. Where I wanted to spend some time with regards to our conversation is also its efficacy in international markets. Now, for our listeners, for those who have invested in US equities, US large caps, perhaps specifically, the last 15 years have been very good to them, Arup. I have a feeling the next 15 years might be a little bit different. In fact, 2025 might be an indicator of what investors might have to get accustomed to. What are your thoughts on this with regards to the US large cap experience and just broadly speaking, international investing?
Yeah, I tend to agree with you, Rajan. US has been the place to be, except this year, as you said. I mean, keep in mind that if you just look at the German DAX index, it's leading the S&P 500 by 30% in 6 months alone. So, which is something I don't see very often, if ever. So, maybe you're seeing the beginning of some of the valuation play working out. MIQE with all international stocks, MIQE is basically EFI strategy, where you invest in European stocks, Asian stocks, and that's where it is all built on. Those have, if you look at any valuation metric, look very cheap compared to, say, global equity, where US is a large component of that. Mainly because US has done very well over the last 10, 15 years. Even in the last couple of years, I've been making this case that if you have extra dough, why not deploy it more towards cheaper markets and have a little bit of a long-term view. I did not see it play out as well over the last 6 months as it has happened. As I said, DAX is ahead of S&P 500 by 30%, again, 30%. So again, cheaper markets, less efficient markets where, again, active money management works very well. I mean, we have three specific models in MIQE. We have specific models for Europe. We pick stocks in Europe. What kind of valuation metrics we look at, what kind of growth, what kind of quality. A specific model for Japan, and then we have a specific model for Australasia ex Japan. So that's how we do the whole world, specific models. Some things work better in Japan, some things work better in Canada, some things work better in Europe. So MIQE takes benefit of these three stock selection models. I've invested in all these markets. I had Japan only strategy in my first career in the late 90s. Europe strategies from 2000 onwards. I've been running money in all these areas for a long time. And I would say these are also a little bit less efficient. So it's easier to beat markets or index funds here than elsewhere. So that's why I would say the valuation is playing out. And in my view, some of the actions coming out of the White House have led to a price to perfection market, US, lag behind other markets where people like Germany are being forced to spend more money either towards defense, others, which is usually good for the markets. And that's what's playing out in the EFI land. I'm just picking out Germany as one example where historically they've been very deficit focused, all that, and not done much spending. But when you start unleashing that, they're now spending 5% or whatever towards defense, as you know, based on the last NATO agreements just a week back. Those will move markets as they are. So I would say the catalyst unknowingly here or unknownly to the White House is happening here for the MIQE space where we play in. That's why I'm excited in this place. And hopefully, the one statement I'll make, which I hope I can back up, all I'll say is the last 15 years of US dominance is unlikely to repeat itself in the next 15 years. I mean, that's all I'd say. I mean, maybe you're seeing the early parts of that. Again, US has great stocks. I mean, don't discount them, a lot of the M7 names and all. But again, they're expensive. So therefore, I would say this is what MIQE brings to the table. You may have, especially being in Canada, North America, you have your fill of Canadian exposure, fill of US exposure. If you're light on in the international front, why wouldn't you add there? Or maybe even go overweight compared to what is long-term allocation should be to the international equity space.
That's great detail, Arup. Now, you do quantitative investing and manage and run a team all day long. For me, it's portfolio construction. I've had many conversations over the last 6 months where many people are surprised to learn when they're using the MSCI World, for example, the US allocation is north of 70%. You made it quite clear. This international strategy we're talking about is EFI, so really ex US. How are those markets different? Before even getting into the quant process, how are they different? Is it just about geography? Is it different focus in GIC sectors? Are they more value oriented markets, or is it all of that and then some?
Perhaps it's all of that. I mean, to me, one reason why the US has done well is its technology, communication services leadership. We can all agree, I think, that the top stocks in the world, the Microsofts, the Alphabets, the metas in that space are US companies. That's what's missing in EFI. I would say those are also stocks which maybe are priced to perfection. Nvidia, I forgot, that's also in that mix. So therefore, I would say as you go into EFI space, which as you just said, it's EFI, international equities EFI, which is Europe and Far East, as by definition, you have a more all-rounded sectoral exposure than in US, which is uh, given the run technology communication services have had the last 10, 15 years are a bit dominated by that space. If you go there to EFI, you'll have a bit more broader exposure, a little bit less technology. And I think, to me, I believe in long-term mean reversion. That may be a good place to be, where you're broadening out your exposure away from the M7. Again, I'm not saying calling a demise for the M7. They're well-run companies. There's a reason why they trade at what kind of premium they trade at. But they are, as I said, a price to perfection area. So why not deploy some additional dollars more to this, other sectors, more to other regions? As I said, Europe is being forced to spend more money on defense, more money on the economy. I think the same is perhaps true for Canada. So for all those reasons, usually those are good signs for the markets. And so a lot of those catalysts are there in place for many of those markets, why they should do well. And on top of that, they're very cheap.
Very good. Now you just referenced they're very cheap, and I know you're passionate about stock picking and most passionate about alpha. Maybe we could peel back a layer on the process and at a high level that would be appropriate for our podcast conversation. Describe the process to us so we can better understand how the team is able to identify opportunities in the international markets.
Rajan, I try to keep my life simple. I believe in a quote unquote all weather core approach. To me, markets are driven by one of three styles at any point in time. Yesterday was all about value when there was a momentum correction in the US markets, as you may be aware. Other times it's been about growth, and other times it's about quality. So, markets at any point in time in my long career have been either a value market or a growth market or a quality market, except maybe the couple of years around the internet bubble in 1998, 99. Our process is built for all those three markets roughly equally. A value manager has too much riding on value, a growth manager has too much riding on growth. We don't do that. In our process, we have value embedded it in, as in we are cheaper than index funds. We have growth embedded in it, as if we have more growth than index funds. We also have quality embedded in it, as in we have more free cash flow margin in stocks we own than index fund. So we have all three embedded in our process. The basic idea, the proposition for us is we have all three embedded. We don't predict tomorrow what will work or day after what will work, but we know it'll be one of those three styles that will work. And we know that we own quite a few stocks in our portfolio based on that style. That's our approach. That's what I've used it all through my career. Hopefully, I've gotten much better at defining what value is, what defining what growth is, and what defining what quality is. So I would say that's what drives our process. I'll also add, Rajan, if I may, there's a lot of innovation that's happened in the almost 8 years GQE team has been together here under McKenzie, the most creative 8 years. I'll just add one stat here. Uh, AI, machine learning, NLP was zero weight or part of my decision making in stock selection when I joined McKenzie. Today, it's about 15 to 20% of our stock picking. That's a key quant advantage. Use of NLP, which is text parsing, use of machine learning. And I would say those are how we have improved while keeping our all-weather core nature intact. We always try to figure out how to define value better, how to define growth better, how to define quality better.
Remarkable. I want to ask you a follow-up question on the investment process, but also put it in real time. By the time this podcast is released, it'll be very close to President Trump's July 9th deadline on trade negotiation deals before potentially punitive tariffs are reimposed. How do you account for that in your investment process? Because as an investor, it has been a topic of, let's say, unpredictability.
Unpredictably, chaos, however you want to call it, Rajan. I would say this is being faced by every portfolio manager, fundamental quant, I don't care. A lot of things are moving based on, Truth Social post, X post, and so on. since January when President Trump came into power in the US. So we try to stick to our knitting. Firstly, as a quant manager, we have a diversified portfolio. So a big move in a name like Ford or a name like Nike or a name like Nvidia doesn't move our process. Secondly, we are also, besides our always the core approach, we are always constantly monitoring the markets. So when we realized early on in early February that this new administration in the US is serious about tariffs, it's not just a talking point, we tightened some of our risk. We realized then, and we knew as a long-time quant manager how to tighten some risk in your portfolio. But I think the after early April, what was called Liberation Day, I guess, after that, I believe, and hopefully I'm right in this, that was the peak of the tariff worry. I hope that's the case. We'll find out in the future. So after that, we have been unwinding that slightly tightening your risk and loosening it. Obviously, you mentioned July 9th is around the corner. It's not too far from now. I have no insight into White House actions. I would say no portfolio manager does. Uh, all I would say is, from what I'm seeing, early signs of what's happened with China, where it went from a huge number to a more reasonable number. I don't know whether it's reasonable, but a lower number. um, I've seen some things come out in the last couple of days also from Vietnam, where it went from a huge number to something more reasonable. Don't get me wrong, I don't like tariffs. I believe in globalization myself, but this is the world we live in. So to me, seems like this is more tractable. And that's what the market's also telling you. The way the markets have rebounded in the last, since early April is telling you that's the market view too. So we are just closely monitoring the situation, Rajan. As I said, there's a hand-holding part of it where we slightly tighten raise, slightly increase back to our normal levels, which is where we are today. Monitoring the situation, monitoring how markets are doing, but most importantly, looking at our own alpha year to date. And I would say, sitting where I'm sitting, you never feel good as a manager, portfolio manager. We run, 15, 20 strategies. I'm feeling pretty good that in most of them, we are ahead year to date as we sit in a pretty chaotic market environment.
We'll get to that in a second. I'm intrigued. You said that you're ahead in many of your mandates. I am curious. I know as part of your process, the team meets every morning. If I remember correctly, it's at 10 a.m. Eastern morning. From my perspective, the sentiment seems a lot calmer, dare I say, almost complacent in the markets versus where we were just 2.5 months ago. When your team gets together, when you think about whether opportunities or risks, for your approach, this is a quant team. What are some of the topics that are surfaced by the members of the team? Because of course this is a quant team, quant model, but you have a very experienced, very bright team of investors alongside you. What topics come up?
We are always monitoring the markets, the economy, how it's going. I agree with you. There seems to be an underlying bid in the markets, which is another word for complacency, as you're saying. At least in the US, seems like there's a lot of retail money trying to buy the markets. And you can't blame them because buying the dip has worked for the last 15 years till it doesn't work, but that's how it has been. So I would say, so we are cognizant of all that. I mean, again, my view maybe the market's a bit ahead of itself, but we are stock pickers. We try to find the best stock anytime in the world. So to me, we are monitoring it. As I said, lately we've been following the China news, the Vietnam news, the India news, the back and forth on Canada, on the digital side, the back and forth, all this. To me, the good news is people are talking, and if people talk, usually you get to some solutions. And I would say, hopefully, um, I hope the White House learned some lesson early April from the bond market reaction, and we'll never get to that point again. But only time will tell. So I'm a bit more calm about things, though obviously July now is very soon here upon us. We'll have to see. But seems like to me we're going one country after. Obviously, we also know which countries the tariff negotiations may be tougher than others. So I'm also focused on those and so on. So those are obviously playing a role. But for us, Rajan, the way we look at things is how are value, growth, quality doing? I'll just say in April, during the first few days of big White House actions, growth got slammed. The past winners got slammed. People fled to quality. But second half of April, suddenly growth came back. And that's been the trade since till June 30th. Early July, the first 1 or 2 days, growths got slammed again. So again, different styles have been working. That's what we focus our time on, Rajan. Which styles are working? Are we being exposed? As in, are we being able to navigate? When I say exposed, we live and die by alpha. Are we being able to add alpha rather consistently or somewhat consistently in this very turbulent market environment? And it seems so far year to date, we are being able to do that.
Excellent. So I want to build on this theme, and you alluded to it earlier. We've been in a pretty challenging environment as investors in 2025, but you made reference to being very proud of the performance. Maybe provide some detail. What's been going on with the various mandates under your purview this year?
I would just highlight both MIQE, our emerging markets fund, our global equity fund. These are the ones, all are ahead nicely in many hundreds of basis points, some many, some few year to date. When I say ahead, I mean versus their index funds. I'm not talking absolute returns. I'm talking always alpha. And that's nice to see. That is, in different areas, EM, international, global, we seem to be ahead by not small, but reasonable margins. Value growth in combination is leading the way for us. We have had lots of noise throughout the year, as I was highlighting even in April. But net, what I'm seeing as we sit today is value growth, which are two of our key pillars, are generally carrying the day for us at different times, but overall year to date, that's what's carrying the day. And that's how, in my view, our all weather core process is supposed to work. Hopefully, that nice balance you build along with this human overlay is carrying the day. I'll add one more thing, Rajan, if I may. Given everything's going on, I would just say we are also seeing a pretty significant value opportunity today. Value opportunity specifically in US markets. The value opportunity we are seeing in the US markets today is at one of the highest levels of the last 3 decades I've been in the market. So what do we do with that information, Rajan? That's not the case in emerging markets, not the case in rest of the world, but it's the case in US large cap. So what we do with that information, that's the human overlay. We have slightly upped our value weight in our decision making for US stocks, say in a Canada focused strategy, not for Canadian stocks, but because we have a US model, we have a Canada model. The US model, we have slightly upped our value weight. Um, we haven't done it anywhere else because that opportunity is not there anywhere else. And like I had done it 3 times in the past, including at the height of the pandemic, where we had increased value weight. The last time the value opportunity was very significant, but that time it was everywhere in the world. We upped our value weight in our decision making, stock picking, and that added extra alpha for our clients. And as I said today, we have done that in the US portion of our global equity fund and so on. MIQ is unaffected because this is not US. But anything that invests in the US Alpha Extension Fund, the Global Equity Fund, we have slightly upped our value weight because when the value opportunity, the valuation disparity within peers gets this high, in the past, it's happened 3 times. Each time I did this, I made extra alpha for our clients. This is the fourth time. Hopefully, this will also work out exactly like the past three have.
Excellent. Arup, I'm just looking at the time. We've come to the end of time for our conversation. I really enjoyed this pretty wide ranging conversation. It was great that I put you on the spot and you delivered with regards to talking about the recent launches that we've seen in Canada for retail investors. Really appreciate the time that you spent on the international equity story. Just touched on the value opportunity in the US. But I was also really glad that we had the opportunity to just talk about performance and manager skill because it has been very impressive, tremendous. And just so you know, we noticed one of my favorite slides in all of Mackenzie is a slide that your team has with regards to the outperformance in the U.S. small cap space. Pretty remarkable that through the end of 2024, if I remember correctly, over 900 basis points of annualized alpha. Remarkable. Thank you again for the time, Arup. It's always nice to have you, and I look forward to our future conversations.
Thank you very much, Rajan. I always enjoy talking to you.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.